Price is climbing toward resistance. From this one area, 5 very different trades can unfold. Price can reject. It can break and hold. It can briefly break, trap late buyers, and fall back. It can break, retest the old ceiling as support, and continue. Or it can lose the level first, then reclaim it. The line itself does not predict which path comes next. A level is simply an area where the trader should pay closer attention to how price behaves. That idea is the foundation for everything in this lesson. A stock level is a price area where market participants have previously shown interest, or where many traders may make new decisions. Support is an area where buying interest may respond. Resistance is an area where selling supply may respond. Notice the word may. Support does not promise a bounce, and resistance does not promise a rejection. A level helps organize attention. It tells you where to watch more closely for evidence, not where to place a trade automatically. Levels are usually better treated as zones than exact pennies. Around a $5 psychological level, one trader may sell at $4.98, another may place an order at $5, and another may wait for $5.05. On a calm, liquid stock, the relevant zone might be tight. On a fast, low-float name, the same zone may need more room. Time frame and volatility matter. Drawing resistance at exactly $5 and calling every 501 print a breakout creates false precision. Levels matter because markets have memory. Traders who bought near a prior high and watched price fall may sell when price returns, hoping to escape near break-even. Earlier buyers may take profits into strength. Breakout traders may wait just above resistance. Short sellers may test the area or cover if it breaks. Stops can cluster beyond a visible high or low. Round prices also anchor attention because they are easy to remember. Different motives can produce real order flow around the same area. Think of resistance as available supply. For price to advance, buyers must absorb enough of that supply for transactions to occur at higher prices. If buying is weak, the area may reject. If participation expands and sellers are absorbed, price can move into the next pocket of liquidity. Support works in the opposite direction. Sellers must overpower available demand to push price lower. This framework is more useful than imagining a magical line that forces price to reverse. The most useful level map often begins with widely watched session references. Previous day high and low show where the last session found extremes. Pre-market high and low frame overnight participation. High and low of day update as the current session develops. The opening price and opening range can reveal whether price is accepting above or below the early auction. These levels matter because many traders, scanners, and algorithms can see them. Visibility does not guarantee a reaction, but it concentrates attention. Dynamic references move as new data arrives. VWAP estimates the session's volume-weighted average price and is closely watched intraday. Short moving averages such as the 9 and 20 EMA can show immediate trend structure. The 50 and 200 simple moving averages can matter on longer time frames. Their value depends on context. A clean reclaim of VWAP with improving volume tells a different story than a weak touch after a vertical extension. The indicator identifies an area. Price behavior still determines the trade. Whole dollar and half-dollar prices attract attention because traders naturally anchor to round numbers. Historical daily levels can carry even more weight. A prior breakout shelf, a multi-day base, a gap boundary, or a major daily pivot may remain relevant long after an intraday candle disappears from view. The strongest map combines timeframes without covering the chart in ink. Ask which areas are visible, recent, repeatedly tested, and relevant to today's price. A chart with dozens of lines makes every candle look important. Stronger levels usually have a reason. Many participants can see them. Price reacted there more than once. Meaningful volume traded nearby. The level is recent enough to matter, and there is room between it and the next obstacle. Clean reactions also help. A level sliced through repeatedly may be less useful than one that produced obvious acceptance or rejection. Select first, observe second. Confluence means independent references cluster in the same area. Previous day high near $5 plus a daily breakout shelf is more interesting than a random line at $4.97. VWAP meeting a prior pivot may deserve attention, but avoid double counting similar indicators as separate proof. 3 moving averages derived from the same price data are not 3 independent reasons. Confluence can strengthen context. It cannot make the outcome certain. Before price reaches a level, study how it arrives. Is demand organized, with higher lows and shorter pullbacks? Is volume expanding into the test? Is the range tightening beneath resistance as sellers are repeatedly challenged? Or is price arriving after a vertical extension, with fading volume and erratic upper wicks? The same line can behave differently because the pressure behind the approach is different. A stronger approach often forms higher lows while resistance stays relatively flat. Pullbacks become shallower, price spends more time near the level, and volume expands as the test begins. Repeated pressure can absorb available supply, but repeated touches are not automatically bullish. Sometimes buyers are simply getting exhausted. Confirmation still matters. The useful insight is that the approach creates a testable expectation. If pressure is real, price should break and establish above the area. A weaker approach may arrive in one vertical push after price is already extended. Volume fades, candles overlap, upper wicks appear, and every attempt is rejected more sharply. That does not guarantee failure, but it changes the trade. A late breakout now has less room to the next level and may require a wider invalidation. When price reaches resistance without a stable base, patience often creates better information than anticipation. Rejection means price tests an area but cannot establish beyond it. Evidence can include a large wick, a close back inside the zone, heavier selling volume, a failed attempt to reclaim, a lower high, and the loss of nearby support. One wick alone may be noise. The dangerous shortcut is resistance touched, therefore short. Strong trends can move through resistance immediately. A responsible plan waits for confirmation, defines where the rejection thesis fails, and respects the possibility that the level will break. A breakout begins when price trades through resistance, but success requires more than one print above the line. Stronger evidence includes expanding volume, a decisive close, continuation, or a controlled pullback that remains above the old ceiling. The level may begin acting as support. Also check the next resistance. A break at $5 with supply at $5.08 offers very little room. Breaking a level and holding a level are two different things, and the second is what confirms acceptance. The break and retest pattern separates discovery from execution. Price clears resistance, then returns toward the area. If selling volume contracts, price holds, and buyers respond, the old ceiling may become support. That can provide a clearer entry and a nearby invalidation. The failed version matters just as much. Price breaks, loses the level, then cannot reclaim it. That failure traps late breakout buyers and can turn the same area back into resistance. The retest is evidence, not a guarantee. A reclaim occurs when price loses an important area, trades below it, then regains it and begins establishing above. Traders commonly watch reclaims of VWAP, pre-market high, prior resistance, and psychological prices. The reclaim itself can show that sellers failed to maintain control, but the behavior afterward matters. Does price hold on a pullback? Does volume support the move? Does the next candle continue? If price immediately loses the area again, the reclaim may have been only a temporary cross. Imagine price approaching $5 from $4.95. It prints $5.07, triggers stops and breakout orders, then falls to $4.88. That is a false breakout because price traded beyond resistance without holding beyond it. Weak volume, no close above, and an immediate loss of the level strengthen the warning. This can be a normal liquidity event where clustered orders execute. You do not need to assume manipulation. The observable fact is simple. The market rejected acceptance above 5. Volume helps evaluate who is participating at the level. A breakout on fading volume may lack sponsorship. A break on expanding volume, followed by price progress and a hold, is stronger evidence. But high volume is not automatically bullish. If enormous volume trades at resistance and price barely advances, supply may be absorbing demand. The question is not only, was volume high? Ask, what did price accomplish with that volume, and did the result hold after the surge passed? Absorption appears when aggressive orders meet enough opposing liquidity to stop price progress. At resistance, buyers may keep lifting offers while a large seller supplies shares. Volume rises, yet price stays pinned. That does not reveal the final outcome by itself. If supply eventually clears, price may accelerate. If buyers tire first, rejection may follow. The stall tells you the level is active and worth watching. The resolution tells you who gained control. A complete level plan answers 9 questions. What is the important area and why does it matter? How is price approaching? What is volume doing? What exact behavior becomes the trigger? Where would an entry make sense only after confirmation? What price invalidates the idea? Where is the next meaningful level? Does the potential reward justify the risk? And how large can the position be if the stop is reached? If any answer is missing, the plan is incomplete. Write the plan as scenarios. If price breaks 505 on expanding volume and holds the zone, then assess a trade toward the next level, using 482 as invalidation. If price wicks above, closes back below, forms a lower high, and loses nearby support, then the breakout thesis has failed. If the reaction is mixed, do nothing. Waiting is a valid decision. The line organizes the plan. The reaction activates it. Trade the reaction, not the line. Common mistakes begin with drawing too many levels and treating each one as equally important. Traders may insist on exact penny precision, buy automatically because price touched or crossed resistance, ignore volume, or use an intraday level without checking the daily chart. Another mistake is assuming support must hold because it held before. Every test occurs under new conditions. The level is a reference, not a contract with the market. Execution mistakes are just as costly. Traders chase the first candle after a break, even when the next resistance is close. They enter without invalidation, then move the level after the trade to avoid admitting the setup failed. They ignore spreads, liquidity, and the distance to the next target. They also confuse a failed long setup with an automatic short setup. When the evidence changes, the first responsibility is to manage the original risk, not invent a new prediction. Now let's apply the framework inside the current Cockpit Control Center. Discovery can begin in the momentum screener, where price, velocity, volume, tape, liquidity, VWAP, fair value, and catalyst filters narrow the market. The highlighted screen is doing one job: finding candidates that deserve review. It is not choosing an entry. From the candidate, open the stock page and verify the catalyst, relative position, chart structure, and usable levels before any scenario is considered. On the current FIEE stock page, the Gamecock chart displays the exact evidence we are discussing: candles, volume, VWAP, EMA9, and labeled support and resistance. The labels on the right identify nearby areas, while the candle and volume history show how price reached them. This chart is not saying buy at support or sell at resistance. It lets the trader compare present price with the surrounding structure and ask where the next decision is likely to occur. The Key Technicals panel makes the scenario specific. In this captured example, current price sits near 637, VWAP near 632, closest support at 632, and closest resistance at 646. The page also lists 664 and 7 as later resistance. Read that as a map, not a forecast. Price is above nearby support, but still needs a reclaim over 646 before the next level becomes relevant. The next panel separates observation from action. The Gamecock tape read says wait, identifies 646 as the trigger, about $6 as invalidation, and 7 as a target. The technical stack beside it adds VWAP, EMA, momentum, and higher-low context. This is exactly how levels should be used. The software organizes information, but the trader decides whether price actually reclaims and holds, whether volume confirms, and whether the risk is acceptable. The advanced trade plan then places the entry zone, stop, and successive targets in one view. A responsible scenario could be, if price holds the 632 area and reclaims 646 with usable volume, then assess continuation toward 664 and 7. If the reclaim fails or invalidation is lost, the idea is wrong. Catalyst, relative position, time of day, liquidity, and risk still matter. CCC provides the information. The trader owns the decision and the outcome. Remember 5 principles. First, levels are areas, not magic lines. Second, useful levels have reasons, visibility, history, volume, or independent confluence. Third, the way price approaches the area matters. Fourth, breaking and holding are 2 different events. Acceptance is evidence. Fifth, define invalidation before entering. Support can fail, resistance can break, and every setup can lose. The purpose of a level is not to predict the future. It is to make the next decision more structured. Trade the reaction, not the line. To put this framework into practice, explore the scanners, stock pages, charting, and trade planning workflow inside the Cockpit Control Center. Start a free 3-day VIP trial at scstonkemporium.com. No credit card is required. This video is educational and informational only, not financial advice. Trading involves substantial risk, and past performance does not guarantee future results.